The space was once seen as a game changer due to its cost advantage over traditional fuels, but it is now faced with tough times going forward. The government has sharply reduced the supply of cheaper domestically produced natural gas to these companies. After cutting domestic gas supplies by over 20% in October, they have slashed another 20% now. Now, this has brought gas allocations down from 154% in FY21 to just 30 to 35% today. Now, what's more worrying is that global brokerage Jefferies has said in its recent report that by mid-2025, domestic gas allocations could come down to nil. And without this cheaper gas, companies supplying CNG for vehicles and piped gas for cooking will have to rely on expensive imported gas, which costs about twice as much. Now, they'll need to source a mix of spot LNG, high pressure and high temperature gas from new fields and APM gas as well, and that will significantly drive up their costs, right? They will in fact need to buy about half of their gas supply at market linked prices, and this will squeeze their profit margins and hit their earnings hard. Now, analysts say that city gas distributors may have to hike CNG prices by up to 10% to protect their margins, but that would reduce CNG's price advantage over petrol and diesel. An ideal scenario would have been gradual price hikes like in the case of petrol and diesel, but with the rapid cut in gas allocation, CGDs may not be able to pass on hikes gradually. And do these companies really have the capacity to stomach such a rapid reduction in gas allocation without taking a significant hit on margins? Probably not, given the fact that price hikes may have to be much larger to remain margin neutral or ensure minimal hit to margins. Gone are the days of 20+% return ratios, but expectations may have to be petered down to 14 to 16% when it comes to return ratios. MK Global, for instance, is now assuming a 14% ROE model for both IGL and MGL for FY26, FY27 vis-a-vis 17 to 18% earlier. ICICI Securities has pointed out that the cost gap between CNG and petrol diesel, which is currently at 35 to 48%, leaves some room for price increases without completely eroding CNG's appeal. But higher prices may still, slow growth as new customers may think twice about switching to CNG. Now, the market has already reacted strongly, right? Shares of IGL MGL have dropped over 40% since October, when the first cut in allocation took place. In fact, now some of these stocks are at levels last seen in 2017. So the question is there more downside? I was just talking to Mayuresh Joshi of William O'Neill today. We were discussing this topic. He said that he believes most of the bad news may already be priced in. He expects these stocks to stabilize, but doesn't really foresee any major positive triggers for now. And there are, of course, short-term challenges with respect to gas availability as well. Now, despite the challenges, the long-term potential for these businesses isn't entirely lost, according to some experts. In fact, they say that they could expand into intercity pipelines, regional networks, and LNG refueling stations, in fact, as well as focus on urban growth and better last mile connectivity. Now, these steps could open up new markets and reduce reliance on specific segments like two-wheelers and three-wheelers as well. Now, some experts I spoke to also said that companies may have to tap inorganic opportunities to improve their prospects. But will these measures be enough? Only time will tell.